So, Steve, first of all, congratulations. We're going to go through a little bit of your career and see how some of your experiences informed and made possible what GoldenTree has become. So we're going to start off right at the beginning. You majored in economics. You spent a couple of years at Kidder Peabody. You wanted to move to the buy side. So then you went to Mackay Shields. And there you thrived. I think you were the top decile manager for a decade. And I guess the question is, how did those early experiences prove useful when you started your own firm?
So starting out in 2000, most of the founders were from the sell side. And there weren't too many people from the buy side. And I was surprised, but it ended up being a huge advantage because most of the people, when they had volatility, were used to managing 100 million, maybe even 500 million. They might have been even managing a team of traders. I was managing $8 billion when I founded GoldenTree. We had 200 positions I knew well, and I had a game plan when there's volatility. My game plan would be simple. What do I think is not going to be affected by what is bothering the market? You know, whether it's tariffs or whatever happens to be the topic du jour that people are unsure about or worried about, whether it was healthcare during Clinton, et cetera. And I also knew, gee, what don't I really like? What's going to be hard to sell? I want to try and sell that. Or if I'm not sure about something, I'm doing that early in a correction because it's going to be a lot tougher. So having that type of experience I always found was a competitive advantage.
So I wrote a book about hedge funds, and it was published in 2010. And I realized when I got to know you a little bit after that I should have known you before that, because I could have written about the trading of credit, which I really missed out. And I think the fact that I missed it out, and I was looking at macro currencies, equities, and so forth, tells us something about the way that trading of credit arrived on the scene later. And in fact, when you were trading credit, both at Mackay Shields and then at GoldenTree, you were kind of blazing the path, right? This was a new thing. So maybe talk a bit about that, and then what's changed in terms of the trading of high yield over the years?
So probably there was about 5 years of trading, I'm going to say from 84, 85 to 89. So that was certainly when I was getting into it and looking at 89 when I started at Mackay. A couple things were interesting to me. There was the commissions, spreads in credit resembled the spreads in equities. So it was certainly very profitable. You also had this perspective, probably not going to last, as they clearly were contracting in equities. There was also this idea that there was a lot of front running, kind of blatant front running, and I heard some chuckles out there from people who've been. I hear Leon chuckling. And so you had to pick your partners carefully, and you wanted to have people you could trust. You wanted to make sure that the people you trusted had a reason to trust you, and that it was a good experience doing business, that they would make money, that they felt that they were appreciated, and that they were incentivized to make sure your best ideas that they would show you first. And that's something, when I look out, it's a little bright up here, but when I was looking out at the cocktail party, how many partners and people who've really contributed to our success and who've just been terrific partners to us, and who we trust, and thank you. And that's something that I learned back then, and very much today. It's certainly something that we want people to feel like we're not the only people doing well, that they've been able to do well with us and grow with us. Another aspect that was different is your menu of choices. You had bonds. Loans didn't really trade. There weren't derivatives. There wasn't really structured products, even though we started with a structured product in 2000. The breadth, scale, and tradability of structured products was very different. So that's also your menu of choices the idea that there was synthetic product, that was an esoteric concept, which has really changed over the years.
And so that brings us on to the origins of GoldenTree. You began with 3 strategies right out of the gate, pretty much. And my sense is that's unusual, right? Most hedge fund founders would have had 1 strategy, 1 fund. What gave you the idea of having 3?
So I didn't go to a book like, okay, hedge fund founding for dummies, and look at it. I just thought, what would be a firm that would do well, that seemed timely, that I felt I could oversee. So I was managing hedge fund money and long-only money.
Yeah.
We weren't managing structured products, but I understood the product. I thought that we'd be good at it. There's also a product which we would have a 4-year investment period, so we were going to have fees which would support the growth of the firm. And I remember in the structured product that when we had the business model that I was showing my partners, some who, it's great that we're still together and here tonight, that that there was a promote on the structured products. And I remember Leon Wagner basically saying, well, you're not going to earn that promote, like it doesn't get paid out. I'm like, no, we're going to beat the promote. And we beat the promote, and I was very, very proud of that. So it was one of the aspects that also, if you're running a trading desk, you usually have a product. So just thinking about your first, on the first question that you asked, that when you have a menu, if you have a Greek diner of options to invest in, you're going to be able to construct something. You're going to be able to optimize something. So having many products was so complementary, particularly to the hedge fund, to be able to pick and choose. And even for the long-only product, to be able to construct the best value, whether it's a convert, whether it was a loan, a bond, or even the equity.
But all the same, I mean, I think about the people who founded funds in the 80s and 90s, whether it's a Stan Druckenmiller or George Soros before that, Paul Tudor Jones. And you had a Greek diner with different things going on. They had a hot dog stand in only one thing. Was it because of a credit background that you had that idea, or had you met other multi-strategy funds before?
So if you're running a bunch of different strategies and you're doing it competently, you think, well, why can't I do that like anywhere? So, was running a hedge fund, was running long only, doing it for a while. So it was, why not, didn't think it would be any different. And if you were to kind of blindfold the results, the first couple of years was not terribly different.
And the year you started, of course, was the NASDAQ crash.
Yep.
Was this a problem? Was it okay? Was it opportunity?
It was awesome. I mean, because if there's volatility, on volatility, if you're running a hedge fund, you got to like volatility. I mean, volatility is your friend because your opinion matters. And so particularly in something like the NASDAQ correction, was really about business models. And there were viable business models, not viable business models, which ended up being a lot of revenue-driven models, and then misrepresented business models. So you look at something like cellular, that really had been built out during the 90s as a duopoly. There began to be a third entrant that was financed in the credit markets. That turned out to be a viable model. Wireless cable, which turned out to not be a viable model, was kind of, if you ever tried it or looked at it, it just didn't seem viable, and it wasn't. And then there were the misrepresented models, which is the polite way to say a fraud. And something like an Enron, the issue was, can you find a needle in a haystack, a special business in this fraud? So in the case of Enron, they had some regulated businesses like pipelines, and those ended up being wonderful investments. And if you appreciate it, they weren't able to mess with those operations, and that was helping them, and what they were claiming, helping them leverage and be in other areas. That part of the business turned out to be very stable.
Yeah, so right. So if you think of a hedge fund or an investment firm as an organization that is paid to take risk, then the more risk, the more volatility, the more you get paid if you do it right. if you're good at it.
Yeah, I think that there's also, you don't always have to do something. And that's something that I've always, took very seriously, that, you want to do something, but you don't have to do something.
Right, right. Now you've got, I think, 10 products. So
Yes.
you've gone from 3 to 10. It's a lot of growth. And that means you've had to add a whole bunch of new skills
Yes.
to the playbook. And that's part of the refreshing of your edge continuously. So share your thoughts on how you execute this growth, how you develop new teams. It reminds me a bit like when I read about venture capitalists, your next good investment idea often comes from something that's going wrong with your other idea. You're on the board of your old company, and then you figure out they're hitting some bottleneck, and then another startup happens, which is going to solve that bottleneck. So one idea leads to the next. Is there something similar in your business?
Yes. When I think of our growth, could we been better or done something better? And then, this didn't seem to work how we thought it would work. So I'll give kind of 2 examples of that. In emerging markets, we appreciated that we were a tourist, and we would usually buy on-the-run securities, and we would trade and it would work. We would tend to focus on corporate debt. So we decided that this was an area we wanted to get broader and deeper. And to take a step back, even from the inception of the firm, the idea was if we were broader and deeper and had more ideas than we had assets, we'd be able to grow, and you could see, and the performance would be seamless. So emerging markets seemed like a logical place to do that. So we want to expand in emerging markets, and we're doing corporate debt. And we find out pretty quickly we're focusing on the wrong area. The larger part of the market isn't corporate debt, it's sovereign debt, quasi-sovereign debt, and currency derivative. Our currency products, local product, local debt. So that's what we focused on. And you look at something like Argentina, we did a fund which wrapped up after 4 years. And if you took the on-the-run name, that would have had the base sovereign piece of debt, call it the 7-year at the time, would have had returns of 1.25. We were able to have returns of 1.75, and it's fully realized fund because we were able to choose what we thought were taking the same risk, better expressions, better upside, lower downside, and so that would be one way that's worked. The other way would be in the M&A side, where being a distressed manager, and particularly having more situations where we're the controlling shareholder, is we found that what we thought something was worth turned out to not be what it was worth. And we're like, well, why is that? So the obvious answer is, the advisors were atrocious. It couldn't possibly be the way we approached it. It was the advisor's fault. So we thought, that is, I thought that a couple of times, and then we said, what, maybe there's a reason why there's this M&A industry, and maybe we could do this better. And so we brought on an M&A group that looks at strategy, makes additions to our platforms, dispositions, and then entire sales. And it's been so much more effective and also very much informed our strategy. And it's complementary when we're looking at an industry to figure out, is this viable? Will this survive antitrust? Not that our analysts wouldn't know to speak to lawyers about antitrust, but certainly having an informed decision where this is their DNA of how to approach something. So those should be 2 examples of us getting better and broadening our playbook.
Let me try an idea on you. So in the venture capital business, a big inflection happened when these early stage companies started to do bigger checks.
Yep.
And so they had to figure out how to do growth investing, which is a slightly different game to the very beginning. And so if you take Sequoia, for example, they tried to do it themselves. They didn't really get it right. Then they hired a bunch of people who were already doing growth investing, and they put them on a different floor of the building. And they weren't integrated with the rest of the team. So that would be like you hiring an M&A team, but not really integrating them into your existing team. And that didn't work either.
Yeah.
And then when they put them together, they got a sort of blend where the sort of dream gene of an early stage investor who's always imagining the best is blended with people who look at numbers, which is what growth investors do. And I'm just wondering, with your expansion, when you bring an M&A team in, is that M&A team the same as what it would be doing if it was at a classic M&A shop? Or is it different if they're under your roof?
So most of the people we've brought on were on the sell side, and they're tailoring their skill set to what we need, which is the portfolio companies, positioning them for growth and to be attractive for to a bunch of different exits, whether it's an IPO, a sale, or a dividend. And what we think is strategically attractive, they're more sensitive. So their sensibility is just better after working with them than what ours was before. In terms of, interesting about scale, and when I think of the credit business, when we first started out in 2000, we would be involved with companies that were like 250, that would be the minimum size. And now that's pretty much private credit. It would be very hard to get something with $50 million. You might see it maybe in the European market, but not really in the US market. And pretty much the minimum is closer to $250 million, at $250 million, and an enterprise value of about $1.5 billion. So the market has certainly actually increased as you were using the Sequoia. So the Series A type of investments are certainly different sizes, today than what it was, 25 years ago.
Another way you've played the game in a differentiated way is with CLOs. So I think you've always had a top quartile track record as a manager of these structured products. And that was, it goes right back to the beginning. It was one of the first 3 products that you had in 2000. But then you're already kind of leading by having that product, but you do something new. So talk a bit about that innovation in the structuring of CLOs. How do you kind of approach improving a product? You're already good at it, but that's not enough for you.
So first I want to mention we won the industry awards of Credit Flux in CLOs and structured products. The awards were tonight, and we won Manager of the Year, the U.S. Manager of the Year, so overall Manager of the Year, U.S. Manager of the Year, Private Credit Manager of the Year. So we're very proud of.
You better go over there.
You know what? I very proud, and that's literally found out about 5 p.m. today. And
were they expecting you to be there to accept the prize?
We were last year, and very proud of the group and lead Mort, just really terrific job, and really. So the idea of trying to make a product better, that's what we're thinking about. And it was a product that was, I think, ripe for innovation. And what I mean by that, it was expensive and laborious to set up. And that was obvious to people who did it, but it turned out that we figured out that the loss ratios were overstated historically, and that provided a lot of vig in the setup, or basically to create these products. These products basically had assets of loans, liabilities of basically, it was $1 billion of loans, be liabilities of, call it about 900, a little less, and then equity. And we figured out that if we raised the equity for a series of structures of CLOs, that we could also economize with the lawyers and the execution and a warehouse, and it would be much more efficient, such that we were able to reduce the cost of setting up these structures by 70%. And we were able to improve the returns by 400 basis points before asset selection. And for us, it was like, wow, we were able to do this, and the idea of creating the perfect structure was what we were trying to do. And we were able to save, to make it more efficient, increase our break even, because these structures, if you have too many defaults, they don't work. But if you can have a more efficient structure, you're able to provide more margin of safety. What I'm very proud of is, since we were on our 3rd fund, and since we established the first fund, this has been integrated into the marketplace. So we feel as if we helped create a better product, and I'm proud not only of how we've done, but that we've been able to create a better product.
Wait, you're happy that the competitors caught up with you? Surely.
It's the fact that we had a different, a better way of doing something.
Yeah, no, I understand.
Yeah,
but it's a double-edged sword, is what I'm trying to say.
They're always going to catch up, and you have to innovate and continue to do well. And so I assume, I remember reading Moneyball, and when Billy Beane was basically saying, I'm assuming that people will look at it, and this is the type of industry where people want to imitate and try and improve upon, and we have to do that ourselves.
When it's your birthday, you get teased a little bit,
Yes.
and I was just trying to, get to this competitive side. We were sitting over there talking about riding on a Peloton bike, and both confessing to each other that you have to be in the top 15%, otherwise.
Yes.
Yeah.
Actually take other pictures of it to make sure that I keep track at the end.
So in the film you showed earlier, there was this point where I think Mike Milken also stressed that this is an employee-owned firm. After 25 years, it still is. Do you envisage going public one day?
No, we really don't. First is you have to be a growing firm, so that's important. And we're very proud that we are employee-owned, and we feel that's a competitive advantage. And when we think of do we need to be public, I think that there's, and it's clearly worked for some firms. For us, we don't want to have budgets to meet, and we rather broaden and deepen our playbook and have more opportunities than assets. We also are focusing on the type of money that we have, and that may not necessarily always be the fastest growing. So it's a type of thing that we're not looking to go public. We raised some money at our hold company, raised some debt, and that's enabled us to invest in our business. We raised about $500 million, and that enabled us to reinvest in our business. And so that's all we need to grow, and so it's not something that we're looking to do.
So, and the type of money matters a lot, and by this you mean the length of the lockup?
Absolutely. And also the type of investors. I've always liked people who spend a lot of time getting to know us. And in the beginning, to the early investors, and there are several original investors here tonight, and it was great that you trusted us. People who spend a lot of time getting to know us, it's great. And the quid pro quo is, to have a long-term relationship. And so, we would rather focus on that.
So let's talk a little bit about the future, and specifically kind of like how you even think about the future. Sure. I kind of like this quote from Vinod Khosla, the venture capitalist, who I got to know when I was doing my last book. And he said always, the future cannot be predicted. It can only be discovered.
Yes.
So it's sort of like what we were talking about before. You start off with one idea. You think, okay, I'm going to do emerging market debt. I'll do corporate debt. And then along the way, you discover that, that the real thing is to do sovereign and differentiate a sovereign. And I think, when you look at the future of the firm, there's one thing is, okay, we're going to have a vision of what, magically, we're going to see what it will be like in the markets in 5 years from now. Which is probably not realistic.
Yeah.
The other one is that you take one step after another and you discover bit by bit what the future is. Yeah. Talk a bit about how you think about this challenge as a leader of the company.
So we're always thinking of just broadening and deepening, broadening our playbook and deepening and going deeper rather for what we do, and so that's easy, and it's pretty much blocking and tackling, and we're going to continue to do that. I look at something like private credit. There's so many different subcategories of private credit that are interesting, and if you have the right people, it can be very exciting and I think profitable and differentiated. When it goes to what we need to focus on is continuing to prioritize the right capital and the right partners. We also, internally, we're a meritocracy, and we have to be committed to have an environment which recognizes and rewards everyone who's doing well. not only our partners, but everyone who's doing well. And that's going to be when you talked about being public. We need to make sure that we have that environment to be able to share that. There's also the aspect of a winning culture, being on a winning team and realizing that you can win together, not just by yourself. And we want people who want to win together. And that's what we have, and we want to maintain that. And I think like any relationship, you have to keep working on it and not taking it for granted.
So really you're saying that the culture, if the culture is right,
Yep.
and you have a great team and people want to win together, you'll kind of jointly together discover the future, step by step. And so focusing on the culture is the way to get the future right.
Well, also, I've also found, yes, the culture is right. I mean, the culture is something which you can't take for granted, and making sure that people who do well are recognized, that people feel that we're stronger together than individually. That's our ethos. In terms of what I found interesting, that there's certain people who we didn't necessarily bring on for certain roles. You take Kathy. She ran our European distribution. Now she's our CEO. And what's really great is seeing people develop and do things that you didn't know that they could do, and do it amazing. So that's.
Well, I think on that note, we've circled back to where Mike Milken ended, which is, we look forward to the next 25 years. So congratulations to you and the firm.
Sebastian, thank you.